All right, let's get right into it. Today, we're breaking down a really critical question facing the U.S. economy. Can we actually fund our national security priorities by bringing back massive tariffs as a major revenue source? Or, in today's interconnected global economy, is that just a recipe for an economic collision?
Okay, so the entire debate, it really boils down to these two numbers you see right here. On one side, you have this massive potential, a revenue stream of up to $600 billion a year, money that could be funneled directly into strategic priorities. But on the other side, you've got a potentially serious macroeconomic effect, a drag on annual GDP that could climb as high as 1.5%. These are the stakes, plain and simple.
And so this leads us to the framing question for any sophisticated investor or strategist looking at this today. Are we talking about a smart, historically proven fiscal tool? Or is this a dangerous gamble in an economic system that looks nothing like it did in the past? That's what we're going to break down. To do that, we're going to follow a pretty clear roadmap. We'll start with the sheer scale of the proposal, then we'll look at the historical case for tariffs. After that, we'll contrast it with our modern economic realities and do a head-to-head analysis of inflation versus the potential drag on GDP. From there, it's all about actionable investor strategies, before we wrap up with the big, unanswered question. What does this mean for long-term competitiveness? All right, let's kick things off with our first section, the $600 billion question. Because to even have this debate, you first have to appreciate the massive scale of what's being discussed here. So to build the case for this policy, its proponents argue that we have to look back. I mean, this isn't some brand new idea. It's actually a return to a proven revenue engine that was, for a very long time, the financial bedrock of the United States.
And this timeline really lays out that historical case perfectly. For more than 120 years, from the country's founding all the way up to 1913, tariffs were the main source of federal money. Think about that. Throughout the 19th century, duties of 20, sometimes even 50%, paid for everything. Our infrastructure, military expansion, you name it. And here's the crucial part. This system didn't kill the economy. In fact, U.S. economic growth averaged over 4% a year during that time. The whole model only changed in 1913 with the 16th Amendment, which brought in the federal income tax we know today.
Now, here's where the modern argument gets interesting. It's about the mechanism. Proponents don't frame this as a broad tax. They call it a targeted consumption levy, or TCL, and that distinction is absolutely critical. They see it as a levy on the choice to buy a foreign product. So the theory goes, the economic burden falls mainly on two groups: foreign exporters, who might have to eat some of the costs to stay competitive, and the domestic consumers who specifically choose to buy those imported goods. It's not seen as a direct tax on American labor or capital.
And this brings us to the number that's driving this whole conversation. A modern tariff policy, scaled at about 10 to 20%, is projected to generate somewhere between $300 and $600 billion in new revenue every single year. That kind of funding could provide a steady, dedicated stream to pay for huge priorities, like a major expansion of our defense capabilities.
But of course, that historical argument has a very powerful counterpoint. So now we're going to pivot to Section 3, the modern economic realities and the case against drawing easy parallels with the past.
This chart puts the scale into some shocking perspective. You see, the tariffs we had back in 2018 and 2019, they brought in over $80 billion. That's a big number, for sure. But look, it's absolutely dwarfed by the current proposal of up to $600 billion. And the argument here is simple. When you scale something up by a factor of 4 to 7 times, you don't just get more of the same effect, you exponentially increase the systemic risk. And here are those primary risks in today's world. First, the very real potential for coordinated international retaliation, where our trading partners start targeting key U.S. exports. Second, massive disruption to these deeply integrated global supply chains that we've spent decades building for maximum efficiency. Third, something economists call friction costs. That's the loss of overall economic efficiency in trade that goes way beyond just the direct cost of the tariff. And all of this, it adds up to that final point, a significant and very real drag on annual GDP.
Okay, so this brings us right to the analytical heart of the debate, a direct comparison of the two big macroeconomic impacts. What's the bigger threat here? Is it inflation or is it a broader drag on economic growth?
Let's look at inflation first. The data we have from the 2018-2019 tariffs gives us a really important benchmark. Independent analyses from the Federal Reserve found that those tariffs added less than 0.5% to overall U.S. inflation. So this suggests that while, some costs do get passed on to consumers, it might not be catastrophic. It might be something the central bank can actually manage.
But that manageable inflation figure gets contrasted with what critics say is the much bigger risk, that potential 1.5% maximum annual drag on U.S. GDP. Now, this number comes from models that assume we'd see a moderate to adverse global response. Retaliation, supply chain issues, the whole thing.
So, to make that percentage feel a little more real, let's just do the money math. The U.S. annual GDP is roughly $28 trillion. A 1.5% drag, you calculate that by multiplying 28 trillion by 0.015. The result? A potential $420 billion in lost annual economic output. That's the potential price tag, and it's a huge figure that basically cancels out most of the revenue we'd be generating.
So you have these two powerful, competing forces in a kind of economic tug of war. On one side, you've got the bull case, a highly targeted stimulus. That $600 billion is injected straight into the defense industry, a sector with a lot of domestic content, creating a strong positive ripple effect there. But on the other side, you've got the bear case, a broad, diffuse drag across the entire economy, from higher costs for manufacturers, to less competitive exports, to less foreign investment because of all the uncertainty.
So, with this complex dynamic in mind, that logically leads us to our next section. How does an investor translate all this analysis into an actual strategy? Well, the debate really creates two competing playbooks for your portfolio. One is offensive and one is defensive.
And here they are, side by side. The offensive strategy is all about trying to capitalize on that targeted stimulus, positioning your portfolio to benefit from the uplift in specific domestic sectors. The defensive strategy, on the other hand, is about prioritizing protection, hedging against that systemic risk and broad economic friction that could hit the whole market. Let's break down that offensive playbook a bit. The focus is on the obvious beneficiaries: big defense contractors, domestic industrial manufacturers, materials producers. The logic is simple. It's import substitution. If foreign goods suddenly cost 20% more, demand for American-made alternatives is going to go up. In fact, analyst models are projecting this could drive a 10 to 20% earnings uplift just in these specific sectors. The key premise here is that the certainty of that government spending justifies a serious reevaluation of these companies. But the defensive playbook, well, it takes the complete opposite view. It focuses on those big systemic risks, the supply chain disruptions, and the international retaliation. The rationale is that a sustained 1.5% GDP drag is a powerful headwind that will wear down consumer demand and business spending across the board. The key premise, that this macroeconomic headwind could easily wipe out or even overwhelm any of those sector-specific gains. So the action plan is clear. Hedge your systemic risk first, before you start chasing those localized opportunities. Finally, this whole analysis brings us to the ultimate strategic consideration. And it's not about the immediate financial impact, but the long-term net effect on America's overall economic standing in the world.
I think this quote from the source material really nails it. The conversation has evolved. The fact that we're arguing over whether the GDP drag is 0.5% or 1.5%, and not about a total economic collapse, suggests the system is probably resilient enough to handle the shift. So the question is no longer if tariffs can fund the government. The question now is, how efficiently do they do it, and at what cost compared to the alternatives?
And so we end with this final critical question for you to really think about. A policy of this size carries significant long-term risks and rewards. So how would you assess the net impact of these tariff-funded priorities on America's competitiveness over the long haul? Beyond the immediate numbers, what metrics would you be watching to decide if this huge strategic gamble was ultimately a success or a failure? That really is the core challenge this policy shift presents to every long-term investor.